Like all strategies that invest for the long term, we held exposure to equities during the period of market volatility, and equity markets fell, and therefore our portfolios also experienced temporary losses. As many of you know, we held allocations to cash and higher quality fixed income, given our view about the less attractive investment environment that we had going into February 2020, which helped reduce the portfolio falls. That's why we held cash with such high weights, was because we were concerned about the reward for risk and the potential downside. The portfolios generally fell less than similar multi-asset strategies and a lot less than Australian equities. For example, from February 21st, the Growth Real Return Fund fell 12.1%, and the Growth Managed Account strategy fell 12.5%. Our guess is that that'll be around 70% of similar peer group type funds or similar multi-asset strategies, and around 45% of the falls in the Australian stock market or the S&P ASX 200. So overall, we felt good about how the portfolios held up in the environment. While we would have preferred to see the portfolio down less on the whole, they performed consistent with expectations. One important point to note is that we have been finding value in more cyclical parts of the share market or the equity market, and based on valuations and our research, these presented more attractive reward for risk. During the sell-off, some of these equities, especially energy and European financials, also experienced substantial falls. Now, the cash in our portfolio allowed us to take advantage of these opportunities, and it provided an important buffer for us during the market falls. The things that we liked going into the market falls are even more attractive now, as are lots of other parts of the market, given how much markets fell. Now, we've got cash on hand to take advantage of these opportunities. That's why holding cash is so important for our strategy. Even when markets fall a lot, we can turn those market falls into an investment opportunity. Following Warren Buffett's advice, we've been able to be greedy when others are fearful. And this was made possible by us being fearful when others were being greedy over the last few years. And that was reflected in the fact that we were holding higher cash than normal and many other investors. Given that, we've been able to add equities and reduce cash and fixed income, as equities have generally become more attractive, with some markets and sectors and individual companies more attractive than others. Generally, we've been adding to Australian equities in more underpriced areas of the market, and also internationally, we've been increasing our exposure, but particular parts of the market stand out to us continue to be energy stocks or energy shares, which have been an area that have suffered a lot in the market falls, but now represent unusual value in our opinion. As I mentioned, this has been funded mainly from reducing our cash piles and selling bonds at very low yields, given the fact that bond yields had fallen heavily during the sell-off. So overall, we've taken the opportunity to increase our equity exposure towards more attractive parts of the market and to reduce cash and bonds. In the short term, we don't know what market prices will do, nor do we think anybody else does. With the opportunities presented by markets over the last few weeks, and hopefully even more attractive prices should markets continue to fall, then prospective medium to long-term returns are looking better and better. As I've said before, the only thing we can forecast with confidence is that markets will fluctuate and that they'll be volatile. And with a very negative fundamental backdrop that we see around the world, it's quite possible that market prices fall further from here, and we wouldn't be surprised by that. Importantly, we'll stand ready to put more cash to work to improve prospective returns even more. Just to reiterate, we don't know what market prices are going to do tomorrow, next week, or next month, or even next year. But over the long term, we believe prices follow fundamentals. And so when we put cash to work, we'll be looking for asset prices that don't reflect the fundamental value of the underlying investment. I'd say make sure you understand our investment philosophy and are willing to invest in strategies that look very different to other strategies. That means at times we'll hold cash at levels much higher than other asset managers. Importantly, at times like these, the environment we're in now, it means we'll be putting cash to work. The cash that we build up during the long bull market will be looking for opportunities to redeploy in the bear market. While others are recommending caution and maybe even recommending reducing risk, we'll actually be increasing risk. So in this environment, should markets fall further from here, we have cash available to invest, and we'll be even greedier than we have been in the last few weeks. That means we'll be transitioning from a strategy that's been more focused on capital preservation to one that's more focused on return generation. It's at times like these with great fear and uncertainty that the best investment opportunities present themselves. To quote Warren Buffett, it's not that we like pessimism, it's that we like the share prices that pessimism brings. Those that think we're permanently defensive, we think will be surprised by how much cash we put to work at more attractive prices during these more extreme volatile periods. As asset prices rise and we think equities and other risk assets get less attractive, we build cash up. And we've been through that process for the last 5 years. Now, as asset prices fall and things get more attractive, we're going to put cash to work. What that means is that we're going to own more and more equities. And as markets continue to fall, it means our strategies will start to experience more and more of those falls. Now, our expectation is that when the recovery eventually comes, we'll actually participate in a lot more of the upside than what we participated going into the crisis or going into the bear market. Now, what that means is for many investors, we need to make sure they're ready for a bumpier ride in our strategy as we come out into the recovery. That's why we have all that cash. That's why we build that cash up. It's so that we can redeploy it at attractive prices and generate much more attractive long-term returns. At the moment, we're transitioning from the phase of capital preservation towards return generation. And that means that you'll start to see a bumpier ride. The good news is high returns go along with that bumpier ride. That is that the reason why we're taking more risk and experiencing more volatility is because we expect higher returns in the future.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.